Chapter 2: Cost Concepts and Behavior. This chapter is heavy on new terms. The first term is cost. Cost is a sacrifice of resources. Usually, the resource is cash. When we buy one thing, we give up or sacrifice our cash. Now, cash is not the only resource that we can give up. We can give up our time or other assets. The most common resource we're talking about when we talk about cost is going to be cash. Any sort of outflow of resources is a cost. Usually, as we discussed, it's an outflow of cash, but it can also be an opportunity cost. An opportunity cost is something that doesn't require any cash, but it's the foregone benefit from an alternative course of action. Another example of opportunity cost is between job choices. Let's say you finish your accounting degree, you're offered an accounting position for $60,000. So, according to your skill level and your educational level, your starting salary is $60,000. If you take that job for accounting purposes, you're going to have $60,000 of revenue. For tax purposes, you're also going to have $60,000 of income. And for opportunity cost, you're going to break even because opportunity cost looks at what skills and experience you have that you qualify for. Opportunity cost expects you to do a job that matches your skills. So what if you do a job that doesn't match your skills? What if you do a job that pays you a lot less? For example, I used to work at Pizza Hut when I was in college. What if I continue to work at Pizza Hut even after I got my accounting degree? I could work at Pizza Hut and make, let's say, $20,000 a year, or I could work in as accountant and make $60,000 a year. Well, let's say I choose Pizza Hut. For accounting purposes, my income for the year is $20,000. Opportunity cost purposes, I'm going to have a negative $40,000. Why is that negative $40,000? It's because I should be making $60,000. I'm only making $20,000. So I have a lost opportunity cost of $40,000. So that's another example of opportunity cost. Another term to understand is expense. Are cost and expense the same thing? Not exactly. Expense is a type of cost, but they're not the same thing. A cost is a sacrifice of resources, while an expense, on the other hand, is a cost that is charged against revenue in an accounting period. So cost is an outlay of resources, while expense is a type of cost that is deductible on your tax return or charged against revenue in the accounting records. This is an important distinction to understand. So let's say you buy a car, you spend $10,000 to buy a car. That's an outlay of resources, right? You have to spend your cash, which is a resource, to purchase this car. Is it an expense? It's actually not an expense. For accounting purposes, you're going to record the car purchase as just trading one asset for another asset. You're trading cash, which is an asset, for a car, which is another asset. Later on, you have depreciation expense, but the initial outlay of cash is not an expense. Now, in recent years, they have changed the tax law, so there are ways to deduct a big asset purchase like a car. If you use it for business purposes, it's called Section 179 expense. There's also bonus depreciation. So they've changed the tax laws up a little bit, but precluding those exceptions, those new laws, when an asset is purchased, that is not considered an expense. Later on, you will have depreciation expense depending on how the asset is used, but the purchase of the asset is not an expense. Another example of a cost that is not an expense is the purchase of land. You've probably learned this in your prior accounting classes, but land is not a depreciable asset. It's different from a building. A building has wear and tear. It's going to last a certain number of years. Because the building doesn't last forever, accounting and tax rules will allow you to expense a portion of the purchase price of that building for a certain number of years. Is that the same for land? It's not. There's nothing to depreciate. Theoretically, the value of that land will rise. For accounting and tax purposes, they don't recognize any sort of depreciation for land. There are some nuances. Land can have minerals or trees or other natural resources, and those can be used up. But if your land does have those things, then they're accounted for separately. But the actual land itself is going to retain its value. Here's an example of an income statement. RPE Associates has $32,000 in sales revenue. Cost of services sold is $23,500 for a gross margin of $8,500. You have your marketing and administrative costs of $4,300 for a profit of $4,200. Now, this income statement is an example of a company that sells product. The company on the prior slide performed services, so the line under sales revenue was costs of services sold, but this company sells products, so you have a slightly different term, which is cost of goods sold. Everything else on the income statement is the same. On the bottom of the slide, it shows the cost of goods sold statement. So looking at this statement, it looks like the company does not produce any products. How can we tell? Because they have beginning inventory, then they have cost of goods purchased, and they have transportation costs related to the purchase and merchandise costs to arrive at total cost of goods purchased. But they don't have two accounts that we're going to see for a manufacturer. They don't have the raw materials account, sometimes called direct materials, and they don't have the work in process account. So looking at the cost of goods sold statement, you can tell certain things. It's important to see what accounts are listed, but it's also important to observe what accounts are not listed. Other observations we can make, since this company has beginning inventory of $300, that means that this is not the first year of the company. In the first year of the company, beginning inventory should be zero, but in this case, it's $300. And that matches what the heading tells us. It says that we are in year 2 of the company. So that makes sense. We have beginning inventory of 300, and so that means that we're not in the first year of business. One other thing to note is cost of goods available for sale. Now, this term is going to be important for us in our homework. What that is you take your beginning inventory, we add what we purchased in the current year, and so we get cost of goods available for sale. So what that means is we started out with $300 worth of inventory. During the year, we purchased another $1,920. So total cost of goods sold could have been $2,220. That's the absolute maximum goods that we could have sold in this year. We see that we didn't sell them all. We sold quite a bit of it, but we were still left with $445 of inventory. And when we subtract the cost of goods available for sale, 2,220 minus the ending inventory of $445, so that tells us that we sold $1,775 of goods. The term cost of goods includes only the actual cost of the goods that were sold. It doesn't include costs required to sell them, like the salaries of the salespeople. Those would be marketing costs, or the salaries of executives, which would be administrative costs. This slide shows the income statement of a manufacturing company, Three Rivers Fabrication. A manufacturing company is a little bit more complicated than a service company or a merchandise company because a manufacturing company makes the products that it sells. Another term to take note of is product costs. Product costs are those costs incurred to manufacture a product. They're recorded as an asset in inventory when the cost is incurred, and it's only recognized as an expense when it's sold. That expense is cost of goods sold. This is going to be different from period costs. So period costs are recorded as an expense in the period that the cost is actually incurred. So again, product costs are costs that are recorded as an asset and added to inventory. Period costs are recorded as an expense in the period in which the cost was incurred. So again, product costs are going to be related to inventory, and that's why they are recorded as part of inventory. They're recorded as an asset. And period costs are non-manufacturing costs that are related to the firm, and those are expense when the cost is incurred. Here are two more terms to learn: direct costs and indirect costs. These are more self-explanatory in that direct costs can be traced directly to the product. For example, years ago, I audited an airplane manufacturing company, and for airplanes, they can trace the materials all the way down to the screws, and they know exactly where the screw came from, which manufacturer it came from, where the metal was mined, every little detail for materials for an airplane. So that's an extreme example of direct materials. You can trace raw materials all the way to the final product. Direct labor is also traceable to the product. So going back to the airplane example, the manufacturer knows exactly which worker or workers work to assemble which parts of the airplane. So in case of a disaster, they can go back and talk to those people to find out exactly what happened to the airplane. For cost accounting purposes, it's not to be able to track disasters, but it's more related to the cost. So with cost accounting, they know that a certain airplane cost a certain amount of money to build because the workers that worked on those airplanes have a certain wage rate, and so they're able to pretty accurately calculate how much direct labor was used to construct a certain airplane. Indirect costs are costs that can't be traced back to the exact product. So this is going to be your manufacturing overhead. Manufacturing overhead includes indirect materials, indirect labor, and other indirect costs. So what would be an example of indirect materials? Well, a lot of companies track materials as stringently as an airplane manufacturer has to. For example, a furniture company probably uses a lot of glue, and a furniture company might choose not to track the exact amount of glue used per couch that they build. So what they might do is they might total up the total amount of glue purchases for a period, like a month, and then they see how many couches that they built in that month, and then they split up the cost among those couches built. So one couch might have a little bit more glue and than another couch, but the company has determined that it's probably not worth tracking the exact amount of glue per couch. So that would be an indirect material. Again, these materials are used and they're essential in whatever is being built, but they're not going to go so far as to trace each drop of glue directly to each couch. The same can be said for indirect labor and other indirect costs. The company has to make a decision as to how much detail they want to go into to trace costs. And if they decide that certain costs are immaterial enough that they don't have to be traced directly, then the company will record the amount spent in a certain period and allocate it among the products built, but they're not going to track each and every item separately. Here are two more terms: prime costs and conversion costs. And like I said in the beginning, there are a lot of terms in this chapter. You should take a little bit of time to learn them, to familiarize yourself with these terms, but you don't have to bother memorizing them for the test. The test is going to be open book. You can use your textbook and your notes. So you don't have to memorize all of these terms, but it would be helpful to be very familiar with them. So first we'll talk about prime costs. Prime meaning primary costs. These costs are going to be your direct materials and your direct labor. Most cost accountants agree that direct materials and direct labor are the driving expenses, the main expenses of a product. And so they've chosen to categorize these expenses as prime costs. Conversion costs are the costs necessary to convert materials into a product. You take your raw materials and you need direct labor to convert those materials into the final product. You also need your manufacturing overhead. Remember, that includes indirect costs, costs that are not directly traceable to the product, but they're still very important costs, and they're essential costs that we can't go without. One thing to notice about these two costs is that they're not opposites. Whereas we talked about direct labor and indirect labor, those are considered opposites. But prime costs and conversion costs are not. They're often taught together and packaged together like they are on this slide, but they're not opposites. And they can't be opposites too, because prime cost includes direct labor and conversion cost also includes direct labor. So it's just another way to categorize certain costs of a product. This slide goes into more depth about period costs. As mentioned before, period costs are expensed when the costs are incurred. These costs are not directly related to manufacturing a product. Costs like marketing and administrative. Again, as these slides point out, these costs are necessary. You can't run a business without having a sales team to sell the items, and you also need your administrative staff to operate the business. So these costs are necessary, but they're not tied directly to the product. So these are period costs. They're deducted in the period that they were incurred, and they're not capitalized into inventory. Cost allocation, another new term. So we've made the distinction between direct costs and indirect costs. Direct costs are tied directly to products. Indirect costs are not. So the business has to determine how to allocate these costs. Allocate just means giving a portion to, in this case, different cost pools. This is necessary when you have a business with several departments that share facilities or services. So if you have a small business, let's say you have a small manufacturer that produces one item, then there's no need to allocate indirect costs such as the payroll department or the accounting department or the management team. But as the business grows, and you might have several products or product lines, those indirect costs are going to have to be allocated to the different products or product lines. It wouldn't be accurate to calculate the profit or loss of a certain product or product line unless you consider all the different costs, including indirect costs such as the accounting department and payroll department. So the company has to come up with a way to allocate those costs among their different products or product lines. So how does a business allocate costs? Step number one is to define the cost pool. So again, the cost pool can be something like the accounting department or the IT department or any other department whose services are shared among different departments of the company. Step two is to determine how to allocate those costs. Now, these costs can be allocated based on what the company decides is the best method. And there's not necessarily a 100% right way or wrong way to do this. So, for example, let's talk about the payroll department. Generally, when a business gets big enough, they form a payroll department to handle issuing paychecks and taking care of HR, paperwork. They don't directly create the product, but they are an essential part of the business. So one sensible way to allocate the cost of the payroll department is to look to see the different ways that the company is divided up. So maybe the company has a location in Houston and Austin, and they see that the Houston office has 70% of the workers and the Austin office has 30% of the workers. So perhaps they allocate the expense of the payroll department 70% to Houston and 30% to Austin. That's one sensible way to do it. Or maybe the company is a manufacturer and they decide to do it based on the number of employees in certain departments. So maybe there's 60% of the employees that are working in the manufacturing portion of the business and another 40% in sales. So maybe they do an allocation 60% to the manufacturing department and 40% to the sales department. Again, there's no right or wrong way to allocate expenses as long as the method is sensible and reasonable. The company can pretty much come up with however method that they choose to allocate expenses. Remember that cost accounting reports are unlike financial reports because financial reports are shared with outside investors, people outside of the company, whereas cost accounting reports are generally going to be kept within the company for internal use. So the company has a lot of leeway in determining how to handle their cost accounting. Here's an example. Rockford Corporation has $1 million in IS department costs. IS is information systems. Some companies call it information systems. Some companies call it information technology. The IS department services the entire company, including the East Coast division and the West Coast division. So we have to allocate this $1 million to the different divisions. So the cost pool in this situation is the IS department's costs. They've decided to allocate based on divisional revenue. So we look at the revenue up above. It says that the East Coast has $80 million of revenue. The West Coast has $20 million of revenue. So total revenue is $100 million. That means that they're going to divide it based on revenue, percentage of revenue. So the East Coast is going to get 80% of whatever cost we're allocating, and the West Coast is going to get 20%. So we take the $1 million of IS cost, 80% goes to the East Coast, which turns out to be $800,000, and 20% goes to the West Coast, which comes out to be $200,000. So to check your work, you take your $800,000 plus your $200,000, and they add up to $1 million. Now we're going to dive into manufacturing cost flows a little bit deeper. We first discussed a merchandise company, a company that just buys products and resells them. So that's something like Target or Walmart. For the most part, they don't make their own products. They just resell other brands. Now, a lot of stores nowadays have their own store brands. Target has Up and Up and some other brands. But traditionally, those types of stores just bought and sold brand name products. On the other hand, a manufacturing company, they create their own products. They create it through raw materials. So instead of having one inventory account like Walmart or Target might have, a manufacturing company is going to have 3 inventory accounts. First, they're going to start out with raw materials. Once they start the process of converting those materials into the final product, oftentimes it takes days or weeks or months to create the final product. I know that piano makers often take over a year to create just one piano. So while those products are not finished, but they're also not raw materials, they are put into the work in process category. Now, work in process can be quite difficult, and we're going to get into it in future chapters, but certain products might be 10% done, some products might be 20%, 30% done. So even though we just have this one work in process inventory account, it could be tracking multiple products at multiple percentages of completion. And then finally, once the work in process inventory is complete, then those items are moved into the finished goods inventory. This slide shows the different components of the three manufacturers' inventory accounts. They all have very similar components and they flow the same way with just a few differences in each one. The one that should look the most familiar to you is the finished goods inventory, so we'll start with that one. You have beginning inventory. Here they call it beginning finished goods inventory. Then you have cost of goods completed and transferred from work in process. A merchandiser would call this account purchases, but since we're dealing with a manufacturer, we are not purchasing the final goods, we're creating them. So beginning inventory plus purchases equals cost of goods available for sale, which we've discussed already. And then you have your ending inventory. So if you have your cost of goods available for sale, that's the total amount, the maximum amount of goods that you can sell. Then you see how much you have left over at the end of the period. That's your ending inventory. So the math will show us what we actually sold, which is cost of goods sold. Next, we'll look at the direct materials inventory. This one should also look fairly familiar. You again start out with your beginning inventory, but instead of beginning finished goods inventory, you have beginning raw materials inventory. Then you add purchases to have your raw materials available for production. Now, this is the maximum amount of raw materials you can use in a period. Then we see how much we had left in ending raw material inventory. So if we take raw materials available for production, subtract out ending inventory, then we know how much we actually did use, and the raw materials that were used is transferred to work in process. The work in process inventory account has the same type of flow, but with a few additional components. You still start out with your beginning inventory, and instead of purchases, you have direct materials transferred from raw materials. Then you also add in your direct labor and your manufacturing overhead. So that's the difference in work in process. There are three additions to beginning work in process inventory rather than just straight purchases or cost of goods completed. You add these three components together to get total manufacturing costs. At the end of the period, you can subtract out the ending work in process inventory, and that'll tell you how much goods you actually did complete and transfer over to the finished goods inventory account. So again, all three types of inventory flow the same way. We use the same basic formula: beginning inventory plus purchases minus ending inventory to get your cost of goods sold, your cost of goods completed, or your raw materials transferred. Now, this slide is a good example of a cost of goods sold statement. You can see how the three inventory accounts are shown on the statement. You start out with your direct materials, you add any purchases, subtract out your ending inventory. You add your direct labor and your overhead. Then it flows to the total work in process, cost of goods manufactured, and finally at the bottom you have your finished goods. So it flows very logically. You'll want to save this slide for a reference for problems 2 and 3 in the homework. Also, you can use page 55 in the textbook, Exhibit 2.8, as a reference for problems 2 and 3 of the homework. Now we have even more terms to learn. We're going to learn about fixed cost, variable cost, semi-variable, step cost, and relevant range. Let's start with fixed costs. Fixed costs means that the total amount of that cost in the period is fixed. So let's say, for example, you own a small gym and the rent on your gym is $5,000 a month. That is considered a fixed cost. So the total amount is fixed. Now, depending on how many members you have in the gym, so if you're trying to do cost calculations and you're trying to see how much rent you pay per member, that amount per member is going to change depending on how many members you have. So if you have one member, that entire $5,000 rent expense is allocated to that one member. But if you have 1,000 members, you're only paying $5 in rent per member. That's a pretty good deal. Much better than paying $5,000 for just one member. Now, whether you have one member or 1,000 members, your rent is still $5,000. So that's why that's a fixed cost. The total is fixed, but the cost per member changes. You compare that to a variable cost. Variable cost means that the total amount of cost is going to vary, but the cost per member is going to stay the same. So let's say on average, each gym member cost you about $5 in cleaning expense. That cleaning expense can include paper towels, equipment wipes, soap, disinfectant, stuff like that. And that costs you on average $5 per member. Well, if you have one member, your cleaning cost is going to be $5. If you have 1,000 members, your cleaning cost for that period is going to be $5,000. So when we mention variable cost, the variable thing is what that total cost is going to be, but the amount per member stays the same. So again, for fixed cost, the total cost is the same, but the cost per member can change depending on how many members you have. But for variable cost, the total cost changes while the cost per member stays the same. So now let's talk about relevant range. Relevant range acknowledges that fixed costs are fixed up to a certain point. So let's talk about the gym example again. Your rent is $5,000 a month, and that doesn't matter if you have one member or if your gym has 1,000 members, your rent is $5,000 a month. Now, what if that's the maximum capacity of your gym, 1,000 members? What happens when the 1,001st customer walks through the door and wants to become a member? Well, at that point, if you don't want to turn that member away, you're going to have to open up a second location. So when we talk about relevant range, if we say that the rent is $5,000 a month with a relevant range of 1 to 1,000 members, that means that that's the total rent we're going to incur with that range of members. If we increase that range, then we have to open up the second location, and at that point, rent goes up. So it's no longer a strict fixed cost because it just went up. So if someone asks the gym owner, is rent fixed or variable? Well, if the gym owner understands cost accounting, he's going to know that if we're talking about a range of members from 1 to 1,000, then yes, the rent is fixed. Now, if we're talking about a range of members from 1 to 2,000, then the rent is variable. Depending on how many members we have, our rent might be 5,000 or it might be 10,000. So to emphasize this point, we look at the graph. It doesn't matter whether our activity level of the business is 0, 1, 2, 3, or 4. Our total cost, whatever cost that they're referring to, is 25,000. So if we have a low level of activity, our cost is 25,000. If we have a high level of activity, our cost is 25,000. That's a fixed cost. For variable cost, the total cost changes. So in this example, if we have no activity, we also have no cost. If our activity level is 1, it looks like our cost is about 7,500. If we have a level activity of 2, looks like our cost is about 15,000. If we have a level activity of 3, our cost is about 22,000. And if we have a level activity of 4, our cost is about 33,000. While this graph isn't exactly perfect, and while my lines aren't exactly perfect, it does look like, depending on the activity level, the total variable cost goes up, but the cost per level is about the same. So the cost per level 1 is about 7,000, 2 is around 14,000, and so on and so forth. So again, the cost per unit stays the same, but the total cost goes up with increased activity. Here is a graph showing a relevant range. In this example, if we have activity between 0 and 1,000, we're not incurring this specific fixed cost. But once we hit 1,000, we do incur the cost, and we incur it up to about 5,000. One example that comes to mind is a party. I know certain party halls have requirements of law enforcement presence when a party gets big enough. So if you have a party with just a small number of guests, let's say 50 guests, then a party might not require a police officer to be there. But let's say you have 51 guests to 200 guests, you might have to have one security officer or police officer. And if you have more than that, you might have to have 2 police officers. So depending on what range of guests you're planning to have, security fees might be fixed. If you have a wide range of guests that you're considering, then security cost would be considered variable. Here's an example of semi-variable costs. So these costs have a fixed and variable component, also known as mixed cost. As we see from the chart, even if we have no activity for a month, we're still incurring a $10,000 expense. Once we start having activity, the expense goes up. So this expense is not a traditionally fixed expense or fixed cost. It's also not completely variable, because even if we have 0 activity, we're still incurring $10,000 of expense. So this is a semi-variable cost. One example might be your electric bill. The more electricity you use, the bigger your monthly bill is. Now, what if you go out of town for a month and you shut off every single thing in your house? You even unplug the refrigerator, disconnect the internet, unplug the modems from the wall, turn off the circuit breaker. You turn off every single thing that uses electricity in your house. Well, your monthly bill is still going to have a charge because there's a fixed component to your electric bill. So your electric bill could be accurately described as a semi-variable cost. Step costs are very similar to semi-variable cost, except that instead of a straight line with an upward slope, it looks more like steps. Using the example of party halls that we discussed earlier, the security expense might be more appropriately described as step cost, depending on what the party hall requires. So if the party hall requires a security officer to be at any event, no matter how small the guest list is, then even if you have 0 guests or 1 guest, you're already incurring the fee to pay 1 security officer. And then once you get to a certain number of guests, then you have to hire another security officer, and so on and so forth. If you had to hire an additional security officer per guest, then that would look more like a semi-variable straight line upward slope. But in reality, an additional security officer is not going to be needed for 1 guest. It's always going to be a block of 50 guests or 100 guests. And so step cost is probably the more appropriate description of security officer requirements in a party hall. Now, here are 3 more terms to learn. I know we've learned a lot of terms today, and as I said, we don't have to memorize them, but we do have to familiarize ourselves with them. Here are 3 components of product costs. Full cost is the sum of all costs. That includes manufacturing and selling. So all costs you can think of, that's going to be included in the full cost amount. Full absorption cost, that's just going to be manufacturing cost. So the variable cost of manufacturing a unit plus the fixed cost of manufacturing a unit is going to be part of this figure. It's not going to include sales or administrative amounts. It's just going to include manufacturing amounts. And then variable cost, we're ignoring fixed cost for this example, and we are looking at all variable costs to manufacture and sell a unit of the product. So there are so many different terms, but you don't have to memorize these terms. Just know where to look for them in your textbook so you can reference them quickly for your homework and also for the test. This is a visual depiction of what we just discussed. In this example, we have 6 different types of costs: direct materials, direct labor, variable manufacturing overhead, fixed manufacturing overhead, variable marketing and administrative cost, and fixed marketing and administrative costs. The terms that we covered just takes the same information and splits it different ways. So if a company wants to know what the absorption cost per unit is, they're just adding up these 4 costs listed here at the top: direct materials, direct labor, variable and fixed manufacturing overhead. If they want to know the full cost per unit, they're just asking for all 6 components. If they're looking for the variable cost, then they're going to look for the total of the top 3 categories and also the variable marketing and administrative costs. So again, all the basic information is the same, just depending on what the company wants to look at the moment. We need to know which components we need to add up to provide the information that they want. This slide explains that for GAAP purposes, for financial reports, full absorption costing is usually used. That's sales revenue minus cost of goods sold to arrive at your gross margin. However, for internal cost accounting purposes, they usually use variable costing. Variable costing is going to be your sales revenue minus variable cost to get to your contribution margin. Contribution margin is an important term. For contribution margin, it basically tells you how much each customer contributes to your bottom line? How much does each customer contribute to your overall profit? Contribution margin excludes fixed costs because, as we've discussed, for a fixed cost, it doesn't matter how many customers you have within the relevant range, of course, you're stuck with that cost. So let's go back to the gym example. Let's say that gym membership is $30 a month. Well, according to GAAP purposes, for full absorption costing, your sales revenue per member is $30. Your cost of goods sold, you're not selling anything to a member at a gym. There's no product or service, generally speaking, sold to that member. So your cost of goods sold would be zero. So your gross margin would be 100%. That whole $30 of gym membership per month, according to full absorption costing, is 100%. Variable costing, however, gives us a slightly different story. If sales revenue is $30 per member, you're not making $30 profit per member, are you? Each member is not contributing $30 to your bottom line, are they? No, because you have other expenses that we discussed. You have your cleaning expense, which is, like, let's say $5 a month per member. You might calculate the electricity expense. Depending on how many members you have, you use a little bit more electricity, so that's a semi-variable expense. So variable costing takes those variable costs into consideration to give you a more accurate contribution margin. So those are all of the terms that we're covering for this chapter. I know there are a lot, and I know that they're confusing, but don't be afraid to use your textbook or any online materials on McGraw-Hill Connect as a reference to get through your homework. So if you haven't already, work out your Chapter 2 homework problems and then watch the homework solutions in the next video.